How to avoid emotional investing and stay focused on the long term. Have you ever noticed how the stock market can feel like an emotional roller coaster? One day you're up, next day you're questioning everything. And the truth is, emotions can be the biggest threat to your financial success. And today, we're going to show you how to protect your wealth by mastering one crucial skill: staying calm when everyone else is panicking. So how do you avoid emotional investing and stay focused on your long-term wealth plan? Hi, I'm Laurent Meunier, partner and advisor here at Safe Pacific Financial. And if you're new here, welcome. And if you've been with us before, welcome back. At Safe Pacific, we specialize in helping Canadian business owners and their families grow, protect, and transfer their wealth using advanced yet easy to understand financial strategies. If you want a trusted Canadian firm to help manage your investments, we're happy to talk and see if we can be a good fit. Thing to do is visit our website at safepacific.com and send us a message through our contact form, and we'll set up a meeting time to go over your current situation and your goals and concerns and take next steps. Today, we're going to talk about an issue that affects even the smartest investors: emotional investing, and how you can avoid letting short-term fear or excitement derail your long-term wealth strategy. So why emotional investing can hurt your financial future. So when it comes to building lasting wealth in Canada, discipline, patience, and a long-term mindset are essential. Yet, when markets get volatile and you see your portfolio value fluctuating, it's completely normal to feel stressed or worried or even overconfident. The real danger isn't in feeling emotion, it's in acting on those emotions without a clear strategy. So panic selling during a downturn or chasing high-flying investments during a rally can seriously damage your long-term financial goals. So at Safe Pacific, one of our core roles as a trusted financial advisor is to help Canadian business owners, professionals, and families stay focused on the bigger picture, especially when times are turbulent. So by learning how to manage emotional investing, you can protect your portfolio, you can preserve your wealth, and you can keep your financial plan on track. So here's how you can stay disciplined and why it matters. Number one, you want to revisit your long-term financial goals. So when market volatility grabs the headlines, it's completely normal to feel anxious, but reacting emotionally to short-term market swings can seriously harm your long-term financial success. And that's why it's so important to revisit your long-term financial goals before making any investment decisions. So before you change anything in your portfolio, take a step back. Ask yourself, are my long-term financial goals still the same? Are you still saving for retirement? Are you still building generational wealth? Are you still planning to fund your children's education or aiming for financial independence? If your goals haven't changed, your investment strategy likely shouldn't change either. Secondly, ask yourself, has my investment time horizon changed? So if you're still years or decades away from needing your investment funds, short-term market drops shouldn't change your overall strategy. You also want to ask yourself, is my income or cash flow or my employment situation still stable? So unless your ability to meet your financial needs has changed, there's likely no reason to panic sell investments at a loss. Fourth, does my portfolio still align with my risk tolerance and my retirement goals? So it's normal to feel more risk averse when the markets are down. But remember, your portfolio was, or should have been, built with market fluctuations in mind. If your retirement timeline or major life circumstances haven't changed, your investment strategy probably doesn't need to change either. Now, why staying focused on your financial goals matters. So many Canadian investors make the mistake of letting emotions and not logic drive their decisions during periods of volatility. So they abandon carefully crafted investment plans because of short-term discomfort. But really, here's the reality. Markets fluctuate. That's normal. They go up and down. There's corrections and dips that happen, and that's part of the process. Your investment strategy should be built to withstand temporary setbacks and keep you on track for your future needs. So at Safe Pacific, we constantly remind clients that short-term volatility is uncomfortable, but it should never derail a long-term plan that was thoughtfully and strategically built. Your portfolio should be aligned with your goals, with your timeline, and your risk tolerance, not with the daily ups and downs of the stock market. So if your situation hasn't changed, the best thing you can often do is just stay the course. Avoid emotional investing mistakes and let time and compound growth work in your favor. Another thing you can do is to tune out sensational headlines. In today's 24/7 media environment, Canadian investors are constantly bombarded with financial headlines that are designed to stir up emotions like fear and greed and anxiety. So whether it's news about a market crash or a housing bubble or recession fears or record-breaking gains, these headlines are not built to offer you smart financial guidance. They're built to grab your attention. But here's what you need to remember. Sensational headlines are not financial advice. Reacting emotionally to media noise is one of the fastest ways to damage your long-term investment strategy. Now, here's why you should ignore financial hype. So the financial media thrives on volatility because fear and excitement generate clicks, views, and ad revenue for them. These media channels take advantage of your lizard brain's fight or flight response to grab your attention and generate an emotional response from you. But no matter how confident the pundit on TV sounds or how urgent the headline feels, the truth remains. No one, not economists or journalists or analysts or YouTube experts, can accurately predict short-term market movements. Your investment plan is unique to you, and it's designed to ride out the natural ups and downs of the market. And then knee-jerk reactions to media panic often leads to poorly timed investment decisions like selling low and buying high. It's the opposite of what you want to do. Chasing trends when markets are booming or panicking when markets dip almost always results in missed opportunities and underperformance. So you want to focus on your personal wealth strategy. At Safe Pacific, we teach our clients to stay focused on their personalized investment plans, which are based on long-term financial goals, retirement timelines, risk tolerance, lifestyle, and your legacy objectives. Your diversified portfolio, whether it's structured with public equities or private assets or corporate investments or permanent insurance solutions, is carefully designed to weather short-term market storms. It's a marathon, it's not a sprint. So when you find yourself feeling anxious about what's happening in the news, you want to ask yourself some questions. So, has my investment time horizon changed? Are my financial goals still the same? Is my portfolio diversified and aligned with my risk comfort? Your best move after asking these questions is usually stay calm, stay invested, stick to the plan. So you want to limit your financial media intake. And one simple but powerful strategy that can protect your wealth is to limit how often you check financial news. So instead of refreshing headlines multiple times a day, consider setting a schedule. So review the markets once a week or once a month. Also, meet with your advisor for scheduled portfolio reviews. This will help you reduce emotional investing triggers, and it'll help you stay committed to your long-term financial success. If you are going to watch or read financial news, I'd also suggest picking one or two trusted sources and not getting information from tons of other sources. Why? Because all of those channels that say buy this or don't buy that can be correct, but they're also not all correct for you, and they're also not all correct all the time. So for example, if you watch anything financial on YouTube, the algorithm is going to start feeding you all sorts of financial videos like flipping Airbnbs or buying commercial real estate or buying stocks for long term or day trading, swing trading, trading only ETFs, trading crypto. All of these things might work for some people, but they for sure don't work if you jump between all of these things and get distracted all the time. So here's a simple real-world analogy using sports. You could become really good and you could play hockey, you could play soccer, you could play basketball, you could lift weights, you could do swimming, you could run marathons, you could do skiing, you could do yoga, you could do any one of hundreds of other sports. If you want to get good at any one of these, you need to pick one, maybe two, and focus on those. If you try to do all of them, you might have fun, but you're not going to be excellent and you're not going to generate results from any of them. So this is like your financial plan. Make one plan and stick to it. There are other plans that can work for other people, but if you stray from your plan and try to do everything that you hear others are doing in the lunchroom or at the barbershop or while you're watching your kid play baseball, you'll never get anywhere. Once you make your plan, stick to it and tune out all the other noise if you want to get anywhere. So at Say Pacific, we're here to help you navigate through the noise and to keep your focus where it belongs, on building, protecting, and transferring your wealth efficiently and sustainably. Another thing you can do is to stop checking your investments every day. One of the most common emotional mistakes that Canadian investors make is checking their portfolio too often, especially during times of market volatility. If you find yourself logging into your investment account daily or even multiple times a day, you're priming yourself for emotional reactions that can seriously hurt long-term results. So here's the reality. Successful investing is measured in years and decades, not in hours or days or weeks. And why should you avoid daily portfolio checks? Well, every single portfolio experiences ups and downs and short-term fluctuations. Short-term fluctuations are a completely normal part of investing. But when you fixate on every market dip or correction or rally, you trigger emotional responses like fear and greed and anxiety. And then what does this lead to, right? It leads to panic selling during temporary downturns. It leads to tracing trends after the market's already gone up. It leads to doubting a well-constructed long-term financial strategy. It leads to making short-term decisions that undermine long-term goals. So in other words, daily monitoring encourages impulsive behavior instead of disciplined wealth building. How to stay focused on your long-term investment strategy. So at Say Pacific, we coach our clients to adopt a healthier and more strategic approach. So you want to schedule regular reviews and review your investments quarterly or semi-annually or during a planned meeting with your financial advisor. Not every time you hear about the stock market went up or down. You want to stay focused on your why. Always revisit your core financial goals. Is it retirement or funding your children's education or building intergenerational wealth or buying a house or giving money to charity? You want to trust historical data. Remember, despite past recessions, corrections, crashes, markets have historically rebounded and rewarded patient investors. You want to diversify to manage risk. So a properly diversified portfolio is designed to handle market ups and downs without needing constant tinkering. And by stepping back and focusing on your long-term horizon, you give your investments the breathing room they need to grow and recover and compound over time. So our approach to long-term wealth building is, we specialize in creating tax-efficient, diversified portfolios that are designed to withstand market volatility and deliver long-term growth. And that's why we work with Harness, who have provided so much safety through this tumultuous time in the market right now. While everyone else's portfolio dropped by 15%, ours with Harness dropped 1 or 2 or 3%. So now whether you're a Canadian business owner, a retiree, or a professional, our strategies will prioritize risk management, asset diversification across sectors and geographies, tax planning to maximize your after-tax returns, and building true, sustainable financial independence over time. So when you have the right plan in place, you can sleep at night, no matter what the market is doing. You want to focus on progress, not perfection. So it's not about having a perfect portfolio every day. It's about having a solid, evolving financial strategy that moves you closer to your goals year after year. Stay committed, stay invested, stay focused. So at Say Pacific, we're here to be your financial partner through every market cycle, helping you grow and protect and transfer your wealth with clarity and confidence. And now, are you thinking about moving to cash? Well, think twice before doing that. When financial markets get volatile, it's completely natural to feel the urge to, play it safe by moving some or all of your portfolio into cash. After all, seeing your investments fluctuate can create a lot of anxiety. But we coach our Canadian clients to be cautious about this move. Now, here's why moving to cash during market volatility can be dangerous. And here's what you risk when you sell all your investments and move your portfolio into cash. Well, there's inflation risk. So while your cash balance might not go down in dollar terms, inflation erodes your purchasing power every year. So in today's economy, inflation is kind of 3 to 6%, could be higher, and this could dramatically reduce what your savings will buy in the future. Your money is losing value even if you can't see it. There's missed opportunity risk. So historically, some of the strongest market gains happen shortly after a big downturn. So if you're sitting on the sidelines when the rebound happens, you risk missing out on crucial growth that your portfolio needs for retirement or wealth transfer or other long-term goals. There's market timing risk. So trying to time the market perfectly and jumping out at the peak and jumping back in at the bottom is almost impossible. Most investors who try to time the market end up buying high and selling low. So they lock in losses and they damage long-term results. And a key question to ask yourself before moving to cash is, if you're feeling tempted to sell all your investments and sit in cash, ask yourself, what's my re-entry strategy? Do you have a clear plan for when and how you'll reinvest? Or are you just relying on emotions to tell you when it feels right? How long can you afford to earn little or no returns? So cash savings accumulate, or you have GICs, these offer very limited growth. And will that support your retirement goals or your long-term wealth plan, right? And what impact will inflation have on your purchasing power? So are you prepared for your savings to lose real value over time if inflation outpaces your cash returns? So without a clear and objective answer, moving to cash could leave you stuck and watching your financial goals drift further away. So how do we help clients stay invested and stay on track? So here at Say Pacific, we believe that building wealth is a long-term journey and that the emotional decision-making that happens during periods of uncertainty can derail even the best financial plans. And here's how we help Canadian business owners and families stay disciplined. We focus on a diversified portfolio that's designed to ride through both good and bad markets. We integrate risk management strategies so clients can weather volatility without fear. We emphasize long-term planning over short-term reaction, helping clients stay aligned with bigger financial goals. And we act as a calming voice during market turbulence so that you don't have to second-guess your strategy every time headlines turn negative. When you have a plan and you have a professional partner, you can stay invested with confidence, even in uncertain times. So stay focused on building wealth, not chasing safety. Remember, wealth is built by staying invested over time, not by trying to avoid every bump along the way. So at Say Pacific, we're committed to helping you to grow and protect and transfer your wealth efficiently, no matter what the market headlines say. And then why staying invested matters. Canadian market recovery statistics. One of the biggest mistakes we see Canadian investors make during volatile markets is pulling out their money at the wrong time and then missing the recovery. So here's why staying invested is crucial. Historical Canadian market data shows that recovery is normal. In Canada, after every major downturn, including 2008 financial crisis, including the COVID crash in 2020, the TSX Composite Index recovered often within a few years. Long-term investors who stayed invested not only recouped their losses, but enjoyed significant growth after the recovery. And missing the best days can hurt your return. So there's studies that show missing just the 10 best days in the market can drastically reduce your overall returns. For example, if you stayed invested in an easy, balanced Canadian portfolio from the year 2000 to 2020, your returns could be more than 50% higher than if you missed only the top 10 performing days in that 20-year period. So the cheesy line is time in the market beats timing the market. So trying to predict when to get out and then back in usually leads to missed opportunities. Canadian investors who stay disciplined, diversified, and focused on their long-term plan generally outperform those who react emotionally to short-term news cycles. Here's some final thoughts, and it's really on the importance of having a calm, clear financial partner. Navigating the world of investing isn't just about picking the right stocks or building the right portfolio. It's about managing your emotions and making clear, disciplined decisions even when markets get rocky. So avoiding emotional investing doesn't mean you suppress your feelings or pretend the volatility doesn't bother you. It means that you acknowledge your emotions, but you stay committed to your long-term financial strategy anyway. And that is where having the right financial partner makes all the difference. So again, at Safe Pacific, we act as the calm, steady hand during turbulent times. We help our clients across Canada to stay focused on long-term wealth-building goals, avoid costly emotional mistakes like panic selling or chasing trends. We help adjust strategies logically and proactively, not reactively, and we help take advantage of market opportunities while managing risk smartly. So we work with Canadian business owners, professionals, and families who are serious about growing and protecting and transferring their wealth in the most tax-efficient, strategic ways. When you partner with us, you're not just getting an advisor, you're getting a financial quarterback who helps you stay clear-headed, strategic, and disciplined, no matter what the headlines are screaming. Now, if you're ready to build true long-term wealth, and if you're looking for a trusted financial advisor in Canada who can help you stay calm through the noise, minimize emotional investing, and build a strong, diversified, tax-efficient financial plan, we're here to help. So visit our website, safepacific.com. You can contact us through the website, and from there, that'll send an email to the team. Somebody will reply to you within 24 hours on business days, and we'll set up a meeting to really find out the goals. We want to talk about the long-term goals that I've been talking about through this whole video. Safepacific.com, fill out the contact form, that'll come to us and we'll reply. Whether you're just getting started or whether you want to refine an existing portfolio, we will walk you through how to protect your wealth for the long term. And before you go, if you found this video helpful, please like it. The best way to do that is hit the little thumbs up like button. You can subscribe to the channel. If you have any questions, leave them in the comments and somebody will reply to you. Or share it with a friend or colleague or a family member who could benefit from having a clear and calm voice in their investing journey. Thanks for watching. That's it for me today, and I will see you next time.